Well, I believe that's going to be the first of many enforcement cases, and that's even been indicated even by various spokespeople and representatives within the IRS and the media. For one, that case with Richard Algren is a landmark case. That was the first pure tax case that came out of the Justice Department that we've seen someone get jail time for. So it really is a landmark case. What happened there is
Welcome back to Only the Savvy. I'm Nicole, and today we're excited to have Patrick Camuso, a CPA and a cryptocurrency taxation expert, joining us. With tax season approaching pretty fast, Patrick is here to help us navigate some critical updates that every crypto investor needs to know. From new forms to regulatory changes impacting decentralized exchanges, there's a lot to unpack today. Whether you're a seasoned investor or just getting started, this conversation will provide valuable insights to help you stay compliant and avoid mistakes. Patrick, thank you so much for joining us today.
thanks for having me. I appreciate it.
Absolutely. Let's start by having you introduce yourself and share what you'll be helping with us.
Yeah, sure. So my name is Patrick Camuso. I'm the managing director of Camuso CPA. We're a CPA firm that works exclusively with crypto investors and Web3 businesses transacting in crypto. And my firm has done that since 2016. So I bring, a deep perspective and a lot of experience when it comes to crypto taxation, accounting, and even how it's evolved over time from a regulatory perspective.
Patrick, could you tell us a bit about your background? What led you to specialize in cryptocurrency taxation, and what kind of work do you do with your clients?
Yeah, so, my firm has been doing crypto accounting since 2016. Before that, I spent about 6 years in the Big Four. And during that time there, I worked doing taxes and accounting for different types of investment management companies, mutual fund companies, hedge fund companies, private equity companies. So there, I built up a good skill set of doing financial accounting and taxation and dealing with very large data sets of financial transactions that we had to apply tax adjustments to and analyze and normalize the data. So while I was doing that at Deloitte, I was researching cryptocurrency. I came across the white paper, very early on, and I was enthralled with it. I told, friends, family, coworkers, everyone I could about it. And after that initial interest, I started to realize that after a couple years after reading the white paper and telling people about it, I started to realize like there is a huge tax and accounting need that's developing here. And it basically came from my own personal need and needs from people around me. And my goal long term was always to start my own firm. So, I realized that was an opportunity, and I started Camuso CPA in 2016 to, serve this emerging need. So back then it was really just working with investors that were mainly in Bitcoin and Bitcoin mining companies. And it's evolved over time to still serving those groups, but then investors came into Ethereum, and then we saw the proliferation of ICOs, then DeFi, then NFTs, now Web3 as we continue to see the industry maturing. And we've grown with the industry, and we work across all chains for investors, and we work with businesses as well that are have more sophisticated accounting needs and tax needs from a business perspective that are transacting on chain. So mainly like what we do is we offer accounting services both to investors and businesses, and we offer tax services, tax preparation and tax planning services also to investors and businesses.
So we've heard that about 75% of crypto holders are non-compliant with IRS reporting. Why do you think compliance is such a challenge for so many people?
Well, I think there's a combination of reasons. It starts with there's a long history of crypto investors not really liking the IRS in general or liking taxation as an ideology. I could tell you, especially in the early days of being a crypto CPA, there was a lot of people that just simply would flat out say they're not paying taxes on crypto. Now that's definitely matured and evolved over time. It's not 2016, 2017 anymore. I believe there's a much higher rate of compliance, but that 75% figure actually comes right from the IRS's website. So there's still a large degree of compliance. And I think, a big part of that is the fact that people believe that the IRS doesn't understand crypto, or we're transacting in a decentralized nature on non-custodial wallets. They believe they're anonymous. I'm here to tell you they're not anonymous, they're pseudonymous, and those are two very different things. And all it takes is to tie your identity to any one of those wallet addresses, and you're dealing with a public immutable ledger where those transactions are going to be there in perpetuity for regulators and tax authorities. So I think there's that aspect where people think that they just don't want to pay the taxes, and they think that the IRS is going to have trouble making them pay the taxes, and that's largely a myth, and I'm sure we're going to be going over that later. In addition to that, to that point, I'll say, like, almost every day and definitely every week, we're having new people come to Camuso CPA that we're going back commonly to the 2016, 2017 timeframe, and often as far back as 2014, to do their accounting and build their cost basis. Because if you're sitting out there and you've neglected your cryptocurrency accounting, you can't just randomly go and do 2024 accounting and start from there. If you've been purchasing and accumulating assets over multiple tax years, that basis carries forward each year. Meaning, the starting point for our cryptocurrency accounting for 2024 is the ending point in 2023, and the starting point for 2023 would be the ending point from the year before that. So this is very cumulative. So that's the other thing. So we're having to go back. It's very common. People haven't been reporting this. The other thing that we see a lot is there's a lot of complexity to this, and this is something that is new even for most accountants, and most CPAs that are trying to wrangle this don't have a deep financial accounting background. So you're working with large data sets of these transactions that are highly complex, and the data that's available isn't always in the proper format for accounting purposes. So especially if you're transacting with complex DeFi protocols or emerging blockchains, you'll likely find that most crypto accounting softwares are not going to be able to give you accurate data. So what it takes then is a very methodical approach to categorizing, reconciling, and performing due diligence to ensure full accuracy. And what I find is a lot of times when people either self-manage their accounting or go to a firm even that isn't deep into crypto accounting, they'll get their accounting done and it'll have inaccuracies. And then it goes back to this issue of the cumulative nature of crypto accounting, to where if previous years are accurate, you need to fix that first before you fix the first year. So I think that's the second reason why a lot of people aren't reporting, is just the complexity factor. When most people get their accounting done, the first thing we have to do is check their ending basis that they've calculated to what it actually was on chain. And that should be something you're doing every year, but I'm seeing many people overlook that, both people that self-manage and people that even use many firms. So there's a lot of inaccuracies. I think that's another reason, just stemming from the complexity and the burden that the record keeping imposes on taxpayers because of the complexity. And the regulations are constantly evolving, and I think there still is a level of people that are just unaware that some of their activity on chain is actually triggering taxable events for them.
Wow, that was quite the insight that you provided to us right there, especially with knowing that it's not as it's a little more transparent than what meets the eye.
Yo, definitely. And we're going to start to see more tax enforcement in the future, and there's going to be people that learn that the hard way too.
I believe it. So going into some new updates, this year introduces the 1099 DA form for crypto investors. Can you explain what this form is and who it applies to, and why is it so important?
Yeah, so 1099 stands for digital asset, which is a term that the IRS uses to refer to cryptocurrencies and other digital assets such as NFTs. And in 1099, people may be more familiar with that. You get 1099Bs from your brokers when you're trading securities. You may get a 1099 miscellaneous or a 1099 NEC for activity that you've done under just in a business sense if you're contracting or being self-employed. So what this form is going to do, the 1099-DA, it's going to report your cryptocurrency activity to the IRS. So this is going to be third-party reporting that's going to the IRS. So this is a big step that the IRS is taking to address this 75% non-compliance rate. So basically, starting this year in 2025, the 1099-DA is going to be going out on transactions this year, and it's going to be reporting third-party reporting going from anyone that's defined as a broker, and that, I think we're going to get into more of the details of that in a second, but that's what it is. It's basically if you're making transactions on someone that's defined as a broker, you are going to be getting this tax form in the mail. Now, this first year, it's only going to be reporting proceeds. In subsequent years, it's going to also be reporting your cost basis details, and there's going to be a whole system on where, if they don't have the cost basis details, you'll have to provide it to them and ensure the accuracy of this all, reconciling it with your accounting to the third-party reporting. So it's third-party reporting going out on taxpayers, and it is going to create another step to ensure accuracy when you're accounting and reporting your cryptocurrency transactions.
Absolutely. So stepping into a little bit of these decentralized exchanges a bit, there are also new regulatory changes impacting these exchanges, or as some of you guys will know as DEXs. What do these changes mean for investors who use these platforms?
Yeah, well, this is a very big deal, and it's something that is kind of in the headlines right now and is still being highly debated. And it's been a point of contention between the Treasury Department and, I would guess, like our industry and the professionals within our industry, I guess since about last summer, I would say. And so we were just talking about the 1099-DA. That obviously is going to apply to like your centralized exchanges like Coinbase and anywhere else. But the way that they've defined broker in these regulations is anyone effectuating a transfer, and it's a very convoluted term. Obviously, it's not something you're going to be familiar with if you haven't been reading through the regulations. But that definition, ultimately, the way it reads now, applies to decentralized exchanges because they're saying they do effectuate a transfer because for several different reasons that we don't have to get too far into the weeds on it. But at a high level, they're including decentralized exchanges in this definition. So going forward, what would that look like? They're going to have to basically KYC you before you use a DEX, KYC all of your wallets, and then report all that information to the IRS. It's going to create like an untold amount of 1099s that's going to go out. There's been statistics that come out on it that there's more 1099s that'll go out just for this than like all of last year for all the 1099s that went out. It's and then people are saying it's going to stifle innovation, obviously, because of the KYC that's going to happen at the DEX level. It's a question of like, will they comply with that, or will they just geogate out people that are within the U.S.? So there's been some crypto associations and advocacy groups that have pushed back against this, and they actually recently filed a lawsuit against the IRS regarding this. So that included, if I'm missing someone, I encourage you guys to look this up, but it included the DeFi Education Fund, the Blockchain Association, and the Texas Blockchain Council. So they've filed a lawsuit against it, and right now Ted Cruz, who's a congressman, has a resolution that's going through Congressional, the Congress right now, trying to repeal the rule that expands this broker definition to decentralized exchanges. So we're still seeing pushback for it. There originally was pushback for it when the proposed regulations came out last summer. There was tons of comments industry-wide basically saying that it shouldn't apply to DeFi and we should revise the definition. They still pushed it forward, so now here we are at this stage, and people are still fighting against its implementation. So we'll have to see how that plays out. But in the future, if this is unsuccessful, you will start to see that reporting also extending to decentralized exchanges. And if this is successful, then of course you won't see that. So it's a very big deal right now, and it's something that a lot of people are watching very closely, and I would encourage everyone else to watch closely as well.
Wow, that's unbelievable. So we've heard about the shift from universal accounting to wallet-based accounting under Revenue Procedure 2024-28. Could you break that down for us? What does it mean for crypto investors?
Yeah, so this is something, that's very important. And when we were talking about the expanding regulatory environment, and sometimes it's hard for people to comply just from, the added complexity and the unawareness. And I think this is something that has flown under the radar of a lot of people. So this revenue procedure came out like late June to early July last year, and it actually had a deadline of December 31st. So by December 31st of 2024, so starting in 2025, everyone has to shift from a universal method of accounting to cryptocurrency to an account-based method of accounting for cryptocurrency. What that means is, under a universal method, if you have 10 wallets with Ethereum in it, it would apply a cost basis method, calculation method, to just that asset Ethereum. Whereas under an account-based method, it's going to apply it to an asset, but also per account. So on wallet A, it'll apply it to that separately from wallet B, separately from wallet C, and then you have to track the transfers and how that basis moves. So it's adding more of a granular level of tracking. Part of the reason for this is to align taxpayer accounting with the 1099 DAs that are coming out, because that's all being reported on an account basis. Another reason why is because in the past there's been somewhat of a abusive tax practice that's been going on industry wide. It's something that my firm has always advised against, because we did foresee a lot of this. But what was happening in the past is that people would do a universal calculation and then they would choose HIFO. And what would happen a lot of times is it would create an audit trail that didn't match their on-chain activity. Meaning if you have like your highest cost basis Ethereum is in a wallet, and then you sold an Ethereum on Coinbase, it'll just apply that highest cost to the sale on Coinbase, even if you didn't transfer it there under a universal calculation on HIFO. So that would be inaccurate. So and it leads to like a completely different tax scenario for the taxpayer. So that's not going to work going forward. Another aspect of this revenue procedure, in addition to requiring the account-based reporting, which is a part of it that stops that, the other part that stops it is now it's requiring something called standing orders. So the default accounting method now is FIFO. It always was, but now it's more clear that it's FIFO. And in order to use Spec ID, which is the method that people then can apply HIFO and other methods to, you have to leave standing orders that are documented for brokers and for non-custodial wallets. And then starting in 2026, you need to provide those standing orders to your brokers. So basically, if someone is first hearing about this, or they haven't complied with this, there's many steps that need to be taken. Number one, you need to get your calculations up to date. Most people that are coming to me to comply with this, their basis is inaccurate, like I was saying before, or they just haven't done their accounting for years. And what needs to be done, the first step is to get your accounting accurate, because we need to get it accurate, we need to get it calculated through 2024, and then we need to allocate that basis, calculated on your universal basis that you reported on in the past, and transition you to the account base. And there's a way to do that, where we have to look at where all your holdings are and then allocate the calculated basis in a consistent manner to there. So number one is you got to get your calculations accurate, and then you have to do the allocations. And then if you're going to use a methodology other than FIFO, you're going to need to document standing orders. And then moving forward, once these allocations are done, another thing we're working with clients on now is there is a tax planning opportunity depending on how you manage your flow of funds on chain, because now where your assets are sitting and what basis applies to those specific tax lots becomes very important, much more important than under a universal method. So there's a big administrative burden to getting into compliance with this, but then there is a tax planning opportunity on the other end.
Okay, so this brings us into a really good question about what you're speaking about right now. So there are cases where some individuals have received jail time. And a special case I want to shout out right now is Richard Algren III, jail time for underreporting crypto sales, which highlighted how serious enforcement is becoming. What does this signal to cryptocurrency investors?
Well, I believe that's going to be the first of many enforcement cases, and that's even been indicated even by various spokespeople and representatives within the IRS and the media. For one, that case with Richard Algren is a landmark case. That was the first pure tax case that came out of the Justice Department that we've seen someone get jail time for. So it really is a landmark case. What happened there is he was looking at 3 to 4 years in jail for each count of filing a false tax return, and I believe it was 3 to 4 years of returns that he filed falsely. We're talking about maybe, I don't remember the exact numbers, I don't have it in front of me, maybe 3 to 5 million in crypto, and that they were claiming that he underreported. The way that they claimed that he did it was that he reported it on his return, but he said the basis was higher than it was. So what happened was he ended up pleading guilty just a few months ago, and I believe he pled out to 3 years. So he'll be doing 3 years in jail for that. What was a more interesting turnout from that, even in addition to the fact that he got jail time, is that apparently it's been reported he has like 120 million worth of crypto that he has in cold storage, and he's even had to turn the private keys over to the Justice Department, and he's not really like allowed. There's like restrictions on like he can't go and like sell that all and just take all those funds. So he's basically had to turn his private keys over to the IRS. So he didn't report his crypto. He's doing 3 years in jail, and he just turned private keys over to the IRS of about 120 million in crypto. And it's still technically his crypto as it stands right now, but as people say, not your keys, not your coins. We'll have to see where this goes for him. So this is definitely an indication that the IRS is serious about tax enforcement, and I've seen many more indications. The 1099 DAs is really like the next step for them. For years, they've been positioning with information collection. For years, I've been tracking this. Before they had these 1099 DAs, they were doing John Doe audits on exchanges. We would see waves of tax notices come out with that. They have international cooperation agreements with other countries. So when other countries go and they get the international exchange records, they'll share that data. So there's partnerships regarding that. So they've been positioning that for a while. Now this 1099 DA is the next big step, because it's basically going to get even more data than they currently have. And we already see batches of notices that go out, and then people come, they'll get tax notices that'll say, hey, we know you have crypto that you haven't reported and you need to report it. And then, they'll come and have to report years and years of it. So I think you're going to see more of that come with the 1099 DAs. The IRS is definitely, serious about reporting the crypto. And I think it starts to show also that, the anonymity is not going to protect you, especially when you start to go under an audit or get indicted by the Justice Department. One of the first questions they're going to ask is for you to turn over all of your wallet addresses under penalty of perjury. And obviously it highlights that tax invasion is a serious crime because of what happened to Richard Algren. So I think that this is the first of many. I think there's going to be more of these larger cases that the IRS is going to want to have and hold heads up, in the media to try to force more compliance. They're going to have the 1099 DAs forcing more compliance. And then, like I said, we see tax notices all the time just telling people like, hey, we know you have crypto, you haven't reported it, you need to report it. Another big case that we've also seen is involving Roger Ver, who is colloquially referred to as Bitcoin Jesus. He was a very big figure in Bitcoin's history, sometimes a controversial figure, but he amassed a large wealth from crypto, and he moved out of I don't have all the details in front of me, but he moved out of the country years ago, and you have to pay an exit tax when you leave the country, and the IRS is basically claiming like he didn't divulge all the assets that he had that he would have had to pay taxes on. That case is ongoing, and it's not clear if those allegations against him are true or not. But it is, another example of them pursuing tax enforcement. And the outcome of that we'll have to see. I think it's going to be another controversial case overall where Roger Ver sort of finds himself again. So the outcome of that one is unknown. But the outcome with Richard Algren III is clear, and he's paying a very hefty consequence for the non-reporting. And when you see that he was non-reporting on $4 or $5 million compared to what he actually had on his ledger, it doesn't even really make sense why you would even do that. You put way more funds at risk now. So I think the big takeaway to everyone is it's like if you're not reporting, you're either going to be getting a tax notice or worse, depending on your fact pattern and the nature of your overall circumstances. And the best course of action is to get into compliance ahead of time.
Yes. Going into that, what are some strategic moves crypto investors can make to minimize their tax liabilities? For example, how does holding cryptocurrency in retirement accounts work? Or even people that might be holding it in ledgers and whatnot. Explain to us, what are some moves that we should be doing?
Yeah, definitely. I would start with, the first step is getting your accounting accurate, because I honestly don't talk to a crypto investor when they first come to my firm that has their accounting accurate. It's extremely rare. And that's going to be the basis for any tax planning that you do. You're going to need to know, what are your capital gains? What income are you looking at? What are your projected capital gains based off of where the market's currently at and what the basis is of the assets you're holding? Are there any loss harvesting opportunities? Those types of things. So that is really the first step, is getting your accounting up to date. And one thing I see a lot of times is people will only focus on the gain or loss for that particular year, and then they'll miss transactions and they won't have them in their ending basis, and then they'll come later years and try to sell assets that's not in their accounting records, and then they're going to have a tax issue related to that. So the accounting due diligence and really verifying the accuracy of your calculations gives you a great foundation to start on. Then I think the next step, the next lowest hanging fruit for an investor, and this is all dependent on your portfolio, but it's to consider loss harvesting opportunities and how wash sales can apply to them. So if you have an asset that's underwater, meaning it's worth less than you paid for it, you could sell it and take a loss on it. But if you wanted to maintain your market position in that asset, and it's just you're dealing with some validity, you could strategically sell it and then purchase it back, and you don't have wash sales that apply to it. You don't have that 30-day wash sales window that applies to it, which would disallow the original loss under securities. So wash sales don't apply. You do need an economic substance to those transactions in order for them to still be legitimate losses that you're going to take, but the wash sales 30-day window does not apply. So after you get your accounting accurate and up to date, that's the next thing I usually suggest, to start looking at loss harvesting opportunities. Then from there, start considering charitable giving opportunities. That is a great way if you're already charitably inclined. If you give crypto assets, it can give you more of a tax benefit, because you can remove the capital gains exposure, still get a discount for the fair market value of that cryptocurrency. So that becomes a tax tool that people use. Now, if you donate more than 5K of crypto, you have to get a valuation on the donation, and that's something I see a lot of people overlook. The reason why is because it's taxed as property, so the IRS requires a valuation on it. Yeah. And then there's retirement and estate planning from there. There are several ways that you can get exposure to cryptocurrencies in your retirement accounts. There's self-directed options, which allow you to take control of your retirement and self-direct your investments outside the traditional retirement accounts. But if you wanted to stay within your traditional accounts, we now have ETFs. So that is another way where you can get exposure without taking on the administrative burden of a self-directed account. So and there's options like ETZ Soft and other softwares that are out there that can really facilitate the self-directed options for you. So there's plenty of options when it comes to that, and the benefit with putting them in the retirement account obviously is the capital gains deferral that you can get depending on the specific vehicle you select. If you're talking about someone that's very high net worth, you can get into more complex estate structures that include different types of trusts, such as charitable remainder, unitary trust, and other types of trusts. I don't want to go too far into the weeds on that and start to turn it all into that, but that's another opportunity for people. And then one big thing, if anyone is founding a project and doing a token launch, one thing that we work with a lot of people on is doing 83B elections for the founders, where they get a token and it's locked for a certain period of time. And if you're expecting the price to appreciate, you can do an 83B election and pay the taxes when you receive the token awards that are restricted rather than when they unlock. So that's a very powerful tax planning opportunity. And other than that, I would say you need to stay up to date on these regulatory developments, because you see these things like the Revenue Procedure 2024-28, you see the 1099 DAs. There's going to be a lot of moving pieces now that we had this change in the administration. Anytime an administration changes, you're going to have tons of changes to the tax code, and crypto is a hot button issue in general. So we definitely have to keep an eye on that as well.
So, for someone new to crypto investing, what advice would you give to them to ensure they stay compliant with the tax regulations from the beginning?
Yes, this is a very good question. What I would suggest firstly is think about the accounting from the start, and meaning I'm dealing with people every day that come to me, and like I said, we have to do these huge cleanups for them, sometimes 5 to 10 years, and we're always dealing with data gaps. So if you go onto some obscure exchange to purchase a crypto on, know that you're going to have to have you're going to have to account for this at the end of the year with your CPA, and you should be doing two things. Number one, you should be keeping contemporaneous notes on those types of trades just in case something happens with the records. And you should download those exchange records almost, if this is just some obscure exchange you're going into very sporadically, not that often, I would say make the transactions, download your history, and just save it. If it's something like Coinbase or something, you're gonna have access to that. You're not gonna have an issue there. But I see a lot of people just miss records, or just the contemporaneous documentation too. You may send crypto to a friend, or they may send you crypto, or you send it to a family member. These types of things where if we're doing the accounting for that, we're just going to see two wallets interacting with each other, and until we tie an identity to that wallet, we're not going to know the nature of that transaction. So having notes on that type of stuff will go a long way. So just thinking about those things is really the first step. And then the next step is getting an accounting system established. And you can work with a firm like Camuso CPA for that, or of course you could also self-manage it as well. But you need to get a good accounting system established, and that's maintained on an ongoing basis, so you can start making those tax planning decisions and understanding where you stand overall with your portfolio. So I would say that's really the first steps, is just making sure you're keeping good records and notes regarding your transactions, and then getting set up on a good accounting system. And then if you take those steps, the tax reporting should be straightforward, unless you start to get involved in transactions that are unclear in more complex DeFi protocols or whatever it may be. And those are things that you want to go and clarify with a CPA, and note down and document the tax position that you're taking regarding that. So I think that's what I would say, is just make sure you're keeping good records and documentation regarding any nuanced activity that you're doing on chain, and get a good accounting system established, and then maintain a close relationship with your CPA, so you can ask them these tax questions about things that may be not totally clear to you, and also so you can get updates regarding regulatory developments as well.
Wow. That was a lot of great information that you just shared for us. Looking ahead, where do you see crypto taxation heading in the next few years? Are there any trends or upcoming changes that investors should start preparing for now?
Yeah, well, I would say definitely more enforcement. I think, Richard Algren is just one of the first cases that we'll see. I think there's going to be a lot more push for compliance for taxpayers overall. There's several reasons why I'm seeing that trend. Richard is just one of them. The IRS even has like RFPs out right now for contractors, so they can basically conduct more audits on crypto investors, to where they're going to partner with tax software companies and then CPAs like myself basically, and contract a lot out of the calculations. And we've seen the IRS themselves indicate that there's going to be more enforcement related to it. So I think the tax enforcement is going to be a huge theme, and a shifting regulatory landscape, I would say, is going to be the other big theme. Obviously, we have the 1099 DAs going out. We have this whole issue of whether it's going to apply to DEXs, and right now, obviously, we're seeing stuff go through Congress and lawsuits related to that. And I think there's going to be more tax changes that come down the line with the change in administration. So I think those are the two big ones: increased reporting and compliance and tax enforcement. The potential for more tax changes overall. So yeah, like an overall focus on compliance and hopefully getting more clarity, and there's definitely going to be a lot of tax changes that we're going to have to deal with.
Well, Patrick, this has been such an insightful conversation. Before we wrap up, can you let our viewers know where they can follow you or connect with you if they're interested in working with you and their taxes or accounting needs?
Yeah, definitely. So the best place to get in contact with me would be my website, which is CamusoCPA.com. It's CAMUSOCPA.com. If you go there and fill out the contact us form, you can reach out to me, and we can have a conversation about your portfolio or your business and see if we're a good fit to work together. Additionally, on the website, we have a newsletter called the Digital Asset Digest that keeps you updated proactively on all of these regulatory developments. And I also host a podcast called The Financial Frontier, where I go over these in more depth that I can't cover in the newsletter. So I would encourage everyone to check those out. And lastly, if you go on the resources page on my website, there is a download link for a crypto tax checklist, the ultimate crypto tax checklist, which is really pertinent right now for 2025. So that can be something useful to everyone out there that's watching as well.
Thank you, Patrick, for joining us today and sharing your expertise. To our viewers, make sure you check out the description, because all of those links that Patrick just shared with us are in our description. So you can definitely check him out and learn more how to get in touch with him. And if you found today's episode helpful, don't forget to like this video, subscribe to Only the Savvy, and share it with someone who could benefit from this information. And as always, thanks for watching, and remember to stay savvy.
Thanks for watching. Help support this channel and receive exclusive offers from one of our partners located in the description. We'll see you on the next one.